hi everyone. It's a great honor and pleasure to present you our work on knowledge discovery with deep reinforcement learning for selecting financial hedges. It's a joint work with David Saltiel, who will be as well talking during the presentation, Sandrine, who is as well here, Abhishek, and myself. We are part of AI for Alpha, and Sandrine is part of SocGen, and we are as well working in the research center of Dauphine and LISIC, which are two universities. Without further ado, I'll leave the floor to Sandrine to explain the motivation of the work.
Hello, good afternoon, good morning. Hello, everyone. So we've partnered with AI for Alpha, Eric and David at Société Générale to try to solve one problem that is really difficult in financial markets. So to give you a little bit of context, in financial markets, usually you buy risky assets, so you're buying equity, but you're most afraid by the downside, so by a crash in equity markets or a crash in all the risky markets. So there are financial products and financial innovations that allow investors to hedge and protect against those downside events. They're called hedging strategies. But the most difficult part is to know when to buy a hedge, so which is akin to trying to forecast the next market crash. And this is a very, very complicated exercise. So the project that we've run with Eric, David at AI for Alpha is that we try to find indicators and techniques that would allow us to time hedges and to provide better protections for investors at the cost of a lesser carry, so at a smaller cost. So that's why we are going to present today.
Okay, so let's explain a quick executive summary. So what are our contributions? So as Sandrine was saying, the problem is quite difficult because you need to time when to invest in a hedge. And if you don't invest at the right time, maybe you pay for the hedge, but it doesn't hedge anything because that's not the right timing and the right hedge for your portfolio. So there is intrinsically, in a sense, a need for adapting to environment and detecting, in a sense, regime changes. So what we did was to use deep reinforcement learning because by nature, deep reinforcement learning is an optimal decision process, in a sense, that needs to adapt to the state through the environment. What we found, and that's very interesting, is that if you use a blind deep reinforcement learning method, it doesn't work so well. So we need, in a sense, to use more information, and we call it augmented states. So additional information that provide you information about the context, and the context that we are taking, we are looking after, are not only the context of our hedging strategies, but as well some indication about the current status of the market. So we use, and we are going to detail that further in the presentation, we use not only information about the equity markets, because they hedge our equity and interest rate, but as well interest rate, credit, government bonds, and as well some indication about the current status of the market. That's the first point. The second point is that you need really to stress test the model. So if you use the regular machine learning method like K4 cross-validation, in a sense, you break the chronology of your data, and it's not so good. So what you want is really to stress test the model and use what is called a walk-forward analysis to be able to see how the model is evolving over time. The third point is that it's quite critical in the modeling to take realistic assumption, and in particular, when you are observing data, the data are mostly not available at the closing closing time, and you need to account that there will be some delay in publication in the data. So what we impose, in a sense, is a 1 period day lag. So we observe data, but we take only action 1 day after. And this is a very critical assumption, and we'll see in the experiment that has a strong impact on the results. So Sandrine is going to present the hedging strategies.
So now to get things a little bit more concrete, this is what we are meaning when we talk about strategies. So we are using, in a way, we're using robot traders on the market. So there are algorithms that are designed to have certain type of behavior on financial markets, and algorithms that are investing in some instruments like options, for example, or like equities themselves, or like bonds. So we are in the work that we've done, we classify those strategies in 4 different big buckets that in a way gives the characteristics of those algorithms. So the first bucket are directional hedges. They're all the strategies that consist into buying a put or buying a form of a put. So a put is an insurance contract that you can buy on financial markets that is an insurance against a fall in the equity market. The second type of hedges and hedging strategies are called gap risk hedging. They are strategies that consist into building a form of convex payoff, convex profile on the prices of financial markets. Think about you're shorting some stocks, or you're shorting the S&P market, but you're shorting a little bit more than the S&P market. And when the S&P market is going to come down, you're going to earn a little bit more than just if you were to short the S&P market 1-for-1. The third type of hedges are what we call rates duration. They're all the hedges that consist into buying a form of government bonds or a form of interest rate derivatives. The reason why we think it's a hedge is because you have negative correlation between risky assets like equities and government bonds are a natural hedging proxy and hedging strategy in diversified portfolio. And finally, we have something that we call proxy hedges. They're all the strategies that are more thematic. They're looking at baskets of stocks, for example. They are like factors in the equity market. They can be some form of trend following. They are not explicit hedges in the way that you're buying an insurance contract against a drop in the financial markets. They are not rates related, duration related, but they are more like a form of proxy, and they will have the right behavior at the right time. As you can see, all the strategies have very different profiles in different type of scenarios and different downsides. So that is an additional challenge that we need to cope with: the non-linearity of those strategies and the fact that they have different return profiles in different scenarios. Eric, back to you. No, sorry. So why do we focus on hedging strategy now? Right, it's very important, and it gives you a little bit of context from a market perspective. We are in a state where markets have become very fat-tailed. If you look at the historical kurtosis of financial market, they've been creeping up for the past 2 decades. So we are seeing a lot of meltdown events followed by melt-up events. We are seeing March 2020 COVID crisis. The market is losing 20, 30, 40% sometimes, and we have a big risk appetite going on, with a lot of people rushing into buying stocks, which creates melt-up. Most importantly, markets have become bimodal, with more upward events and downside events. So all those things means that going forward, looking into 2021, there are more and more risks for a market correction, and that's where investors will need hedges.
So David will present.
Thank you, Sandrine. Yes. Okay. Hi, everyone. So about the mathematical formulation, as Eric said earlier, we can split our data into 2 types of observation. We have what we call the regular observation and what we call the contextual information. So for the first part, the regular information, we have all of that data that are linked to the environment. So we have all the data directly linked to the problem to solve. For a financial problem, here we have, for example, as you can see, the renormalized data. So we rather use the past return compound. So you have here the for example, to a certain time t, you have the price divided by the past price, and you have some empirical standard deviation. And you have what we call the contextual information. So in addition to the regular data, the observation, we have some feeling about the market. So these data are not directly linked to the portfolio, but we assume that it has some predictive power for the portfolio assets. So in that case, for a financial portfolio, the context information is typically modeled by a large range of features such as level of risks. So you have risk aversion in financial market. You have some bond equity historical correlation. You have some credit spreads of global corporate investment grade. You have information about the equity implied vol. So that's a measure of what we call the fear factor in financial market. You have the spread between the yield of Italian government bonds and German government bond, as an example. You have some US Treasury slope. That's a classically early indicator for the US recession. And you have some financial variables often used as a gauge for global trade and activity. So that's about the data. And so as I said, we have two types of data. So we have two inputs. That's sorry, Eric. No, the previous slide. Can you go back to the previous? Thank you. So as I said, we have two types of data. So we have two natural inputs of our networks. We have multiple in here, two inputs network. So the first input network is about the natural data, and then the second one is about the contextual information. And we use here some convolutional network. So just to explain to stress the reasoning here, we try to apply the same reasoning as in image recognition, as you can notify some correlation between some pixels and find some information related to the environment around each pixel. So we develop the same reasoning here to find some correlation and time dependency between the data, as we use some convolutional network here. And so with this kind of network, we have a type of output which is the reward we use only at the end. So it's a replay buffer here. So we use as an example here the final net profit of the strategy. So as you can see, we use only the final one and not the directly at each time the reward of the strategy. We can decide using instead of using the final net profit, you can use the Sortino ratio. So it's here the Sortino ratio is just the expectation of the strategy divided by the downside standard deviation. And as you can see, we decided to use a convolutional neural network, but we can use, instead of using a convolutional, we can use LSTM layers. And about the experiment, so as you can see, we have some data from May 2000 to June 2020. The benchmark here to compare our model is the risky asset here, is the MSCI World Index. And as Eric said, just to have in mind the output, so we have to allocate between here 4 proprietary hedging strategies, and the model has to dynamically reallocate between that 4 kind of strategies. And we use, as Eric said, the walk forward method. So traditionally in machine learning, we use what we call the K-fold cross validation, but using that kind of method, we break the time dependency and the temporality of the data. That's why we use what we call a walk forward and an onward walk forward method to have just a trained set that is going to be extending around the year. And we just have, as you can see, the blue part, the test set every new year. So that we call a non-code walk forward. I think we cannot hear you, Eric.
now let's move on to the results, and let's put a little bit of motivation. So if you use standard method like Markowitz, they don't work so well because they are not able to adapt to regime changes. So they work in this part and they fail to adapt to this new environment. If you use a pure trend strategy, which is to take the best hedging strategy that over the past, it worked well in 2010, but then it's mostly providing no hedge because it's in parallel compared to the risky asset. And if you think that you should play the mean reversion in a sense and play the a contrarian scenario, it doesn't work neither. So the solution here is that we found that deep reinforcement learning can work, yes, but you need contextual information, because if we apply blindly deep reinforcement learning without any context information, it's not working that well. The risky asset here is in blue. The deep reinforcement learning model without any context is in green, and the one which perform and is able to detach more and more from the risky asset is the curve in orange. If we compare with other methods, so that we compared with Markowitz, the deep reinforcement learning model without any context, the winner, the loser, the risky asset, we see that what is amazing is that over 5 years, and we are able, if you look at the Sharpe here of a pure risky asset strategy, here it's around 0.6, and we are able to improve tremendously the Sharpe from close to 1. Same for the Shortino ratio. So we have a better return, and we are able, in a sense, we are able to reduce drawdown. Obviously, that's the method. This method is not the best in terms of reducing the drawdown, but in terms of the Sharpe ratio, the Shortino ratio, and the return, that's the best method among the peers. What is interesting as well, so next slide, is that we did a lot of tests. So we say, oh, should we use in terms of the model architecture convolutional neural network, or should we use LSTM? The intuition between the two is that convolutional neural network is able, in a sense, to detect pattern. Like that's why it's so widely used in image recognition. LSTM, in a sense, is able to detect time dependency because it has a memory mechanism. So what we found is that the memory mechanism doesn't work as well as the pattern recognition capacity of CNN. The second thing, which is very interesting as well, is that there is a substantial impact of the day lag. And remember, if you apply the model just as soon as you have observed the data, and you assume that you can trade at the closing time, then you have a better performance compared. It's a 5-year performance compared to 1-day lag, and the 1-day lag is significant. It's about a quarter of the performance. So ignoring the 1-day lag is quite critical, and this is very surprising that in most DIL paper, this practical detail, which does matter in real life, is often ignored. The other thing is that if you compare the model with contextual states, with the same model without contextual states, you see that the top models are always contextual information. So adding a context is really meaningful. Last but not least, we check the impact of doing what is called adversarial training, meaning that you put some noise in the data. It's very similar in a sense to dropout in a deep network. And it's a way to make the experiment more robust. And we found that it has a slight improvement in performance. So I think last slide, because we are right on time. Conclusion. So what we can say is that deep reinforcement learning is a viable method to time hedging strategies. You cannot apply deep reinforcement learning blindly. You need to add more information, and that's why it's this talk is very relevant in the KDF workshop, where we want to emphasize the importance of data, and these are the data contextual information which are very relevant. The second thing is that it's very important to do a walk-forward analysis, and that's something that we would like to see more and more in deep reinforcement learning papers, because that's a way to revalidate the robustness of the approach. And the last but not least is that if you want to be in real life condition, not only do you need to include transaction costs, but you need as well to include 1-day lag, which is a really great concern, because you cannot say that you are able to trade because there is some lag between the publication of the data and the moment where you can trade.